Good evening. Thank you for joining us for our second town hall. A lot's happened since March, and we look forward to updating you tonight. On the call with me this evening are advisors Dan McGreevy, Joe Lowe, Raj Chatterjee, and Nik Wearsch. We'll be discussing where we're at, what you may want to consider doing, and of course, answering your questions. To ask a question during the event, if you're on Zoom, in the bottom of your screen, you'll see a little Q&A. Just click on that and you can chat the question. We'll get to as many as we can. As always, reach out to us individually and we can answer questions for you. We understand the market volatility and uncertainty with everything that's happening, from the response to the coronavirus, to riots, to politics, can be at least unsettling for some and quite frightening for others. As with almost any time in history, we are hearing this time it's different. And frankly, in some respects, it really is. The speed at which things are changing and the overwhelmingly negative media attention are different from the past. On a positive note, so is the government's response, with more than $4 trillion spent on the economy. What's not different is why markets move up and down. Markets go down when people sell. Markets go up when people buy. And focusing on the short term can really distract us from our overall plan. It's kind of like watching a man with a yo-yo walking up a hill. If you focus on the yo-yo, you just see the ups and downs, and you miss the fact that he's going up that hill. I've been in the financial services industry for more than 30 years. Corrections, uncertainty, even pandemics are not new, nor is the reaction of the markets. It's quite a year when you have riots in 110 cities across the country, a pandemic that's killed more than 100,000 people in the United States and more than 1 million people worldwide. And at the same time, we celebrate a historic manned space flight. But what I've just described isn't 2020, it's actually 1968. Following the assassination of Martin Luther King Jr. on April 4th, 1968, there's a 4-day period of riots across the United States, much like what we saw after the murder of George Floyd. In 68, the Hong Kong flu came to the United States and killed approximately 100,000 people. Most of the deaths at the time were people 65 or older. And on a positive note, 1968 marked the first crewed Apollo missions and more than 157 satellites. Now, we believe there are several new factors that are exacerbating the volatility that we're seeing now. First, social media. Second, the competition with the mainstream media, which creates more focus on the negative. It's ironic. It's illegal to scream fire in a crowded theater, and yet the media seems to do this every day. The third thing that's exacerbating and amplifying some of the short-term movements is program or computer trading. In the 1980s, about 15% of all stock trading was done with computers. Now, on a typical day, computers account for 50 to 60% of the market trades with no human interaction. And when the markets are extremely volatile, computer trading can make up about 90% of the trades. So in the coming months, we anticipate continued negative media regarding the coronavirus, markets, politics, and economy. We do expect more volatility to both the markets in general and portfolios. We foresee hearing about some of the highest unemployment rates ever, along with poor corporate earnings. And then, of course, the things we don't see, because it's never the bus you see coming that hits you. Regardless of the news, we expect it to be predominantly negative. It's interesting that last year, the National Academy of Sciences looked at people across 17 countries and concluded people do pay more attention to negative news than positive news. As we approach the 2020 election, our national conventions, consider the following. If we look at 2016, Most of the news, as you can see from the chart, 60-80% was negative. And it's important to note that the role of the media really is not to inform, but to sell advertising. And again, we don't want to focus on the yo-yo, which can lead to making emotional decisions on limited or biased information. Now, we believe that your asset allocation is the largest factor impacting both the volatility of your portfolio and the returns you see. And generally, the less volatility, the lower the returns over time. The greater the volatility, the greater the returns over time. As the chart shows, you can look at an allocation over different periods. The longer you stay invested, the less likely to have negative results. We will discuss with you what allocation makes sense for your situation, and then we can balance your needs with your risk tolerance. Now, we don't have a crystal ball, but the good news is our planning process, the personal vision planning process, isn't dependent on predictions. Rather, it's based on you, your needs, and understanding that unforeseen events can and will happen. Our personal vision planning process is proactive versus reactive. And that's why we hold cash and fixed income investments for periods of uncertainty like we're experiencing now. The amount that we hold is going to be based on you. Generally, at least 6 months to a year's worth of cash and other stable things should you need them. And if your portfolio is down, then we do have cash set aside for emergencies. Moreover, many portfolios are designed to generate income, which is not dependent on the markets. And a lot of that income tends to come at the end of the year. We believe actually that the greatest risk most people face today, it's not the markets or the economy, but it's doing something to hurt oneself, like panic selling or not investing and keeping up with inflation. Now, just like we discussed in March, there's a natural desire to get out and wait for things to get better or to protect what's left. Unfortunately, that's never a good idea because it's very difficult to time. And in fact, there can be tax implications as well. It's impossible to time the bottom of the market and then get back in when things do get better, which just means you're waiting till it gets higher. In fact, about 96% of market gains are in just a relatively few number of the days. Actually, 0.9% of days have most of the returns. Those that got out in March of this year have missed the biggest 3-month rally in history that we've experienced. Missing just a few of the best days dramatically hurts returns over time. And unfortunately, or fortunately, most of the best days are mixed in with the worst days. 3 of the best days in the market's history, including the biggest day ever for gains, have been the last couple months. Now, on March 9th, the S&P declined by about 7%, triggering what they call level 1 alert, and they stopped trading for 15 minutes. The same thing happened on March 12th, 16th, and 18th. But then on March 24th, the Dow went up 11% in a single day, the biggest one-day gain since 1933. The week of April 10th, the Dow went up 13% in 1 week and was up 27% from its low, the best week since 1974. So clearly, missing a few of the best days is a problem. If somebody had invested $100,000 20 years ago on January 1st, 2000 in the S&P, it would have grown to $324,000 by December of 2019. If you missed the 40 best days, just the 2 best days on average per year, your 100,000 went all the way down to 47,793. So we believe that volatility can provide opportunity, can also provide risk. We've had dozens of calls from people asking how they can take advantage of the current situation and volatility. We believe there's really 3 ways. First, if you have cash, you can shift more into equities based upon your allocation. Second, you can do tax swaps, moving from an investment that's down to something else, staying invested, but taking a write-off. And third, you can convert tax-deferred money, such as IRAs, to tax-free Roths. The other thing that's happening now is the government has extended the ability to make IRA contributions until July 15th. They've waived the required minimum distributions for this year if you're over 70 and a half or 72, depending on which group you fall into. And they've given people until August to put distributions back in to avoid the tax. Now, one question that's come up quite a bit is with regard to elections. Should I wait to invest? As we discussed, market timing doesn't work. So the quick answer is no. There's no conclusive evidence indicating what somebody should do based on the party that's been elected. What we can tell you is in 23 election years since 1928, 17 of those years have had positive returns. And the average election year return was about 7%. In the calendar year after an election, the average return is about 5.75%. So, what do we think is going to happen with the markets, the economy, the election? Frankly, we don't know. And honestly, it's probably the wrong question. It's not about what's going to happen to the markets or economy. The important question is, how will what's happening impact me? And if the answer is it's not, because of the planning process, because you have cash, then it's more of an academic discussion. Now, some pundits are saying the markets have gotten ahead of themselves and ahead of the fundamentals. Dan is going to chat a little bit about that and the importance of dividends. So Dan?
Thank you, Randy, and good evening, everyone. The stock market is detached from fundamentals is something people in our industry like to say, and we've been hearing it so much lately. We believe the market's fully valued, undervalued, overvalued is another crowd favorite. And then there's the market's trading at fair value. We enjoy a good valuation discussion as much as the next pundit, but valuations require a ton of context and can't always be taken at face value. You have to consider different accounting methods, how those methods have changed over time, the composition of the market in question, how companies change over time, the fundamentals you're measuring, whether that's earnings, sales, cash flows, book value, how you calculate those measurements, interest rates, inflation, economic regimes. You see where I'm going here. It's a very complex item to measure. One of the simplest yet most overlooked stock market fundamentals, the dividend yield. And you're all familiar with that. We talk about that in our regular planning meetings. Cash flow is an important component of total return over time. And dividends are simply actual cash flows being paid out by corporations into your hands as investors. You can't fake, manipulate, or fudge a dividend payment by hiring a talented CPA. Dividends also happen to be one of the most resilient features of the market over a long period of time. Here's a look at dividends after accounting for inflation from 1920 till now. A little bumpy at times, but the real growth rate of 2.1% over the rate of inflation over the past 100 years is pretty impressive. It doesn't sound like much, but the inflation rate over this time frame was just shy of 3%. So nominal dividends have grown at an annual rate of roughly 5% since 1920. This is one of the more underrated parts of investing in the market. What other forms of income grow at a higher rate than inflation over the long term? Of course, that growth doesn't always come in a straight line, as we know. Dividends are not immune to economic downturns, as we've experienced so far this year. Disney announced in recent weeks the company would be cutting their dividend to save money, and they're not alone. Morgan Stanley projects the market's currently pricing in roughly a 15% haircut this year to dividend payouts, and they aren't expected to fall as much as one would assume. Considering the market fell 35% in 33 days from February 19th to March 23rd, and profits will likely fall dramatically more in the quarters ahead, it doesn't sound all that bad. Here's a look at how much dividends have fallen throughout the past 100 years after adjusting for inflation. On a real basis, dividends have never fallen more than 50% since 1920, despite the stock market getting cut in half in 5 occasions. You get a much better sense of the relationship when viewing the real drawdowns in dividends, which is the orange, versus the drawdowns in the S&P 500, which is the blue. So you can see the correlation there is not as severe for dividend payments. Even during the Great Depression, when the market fell more than 80% on a real basis, dividends fell only 47% or so. Dividends snapped back much quicker than the market after that period as well. It nearly round tripped before stocks fell an additional 50% in 1937-38. Dividends fell just over 20% in the nasty 1973-74 market that witnessed stocks fall more than 50% real. Real corporate payouts fell just 12% during the tech bubble in 2000-2002. And in 08-09, we saw dividends fall roughly 25% when the market fell well over 50. So today, the S&P 500 yields just shy of 2%. It doesn't sound all that juicy until you realize it grows over the long term at a higher rate than inflation. The 30-year Treasury bond yields approximately 1.4% at the moment. And the income paid out by corporations in the form of dividends is far less volatile than the prices of those companies. So the last point is another reason that market valuations are so difficult to put into practice as a timing indicator. Stock prices tend to overshoot their fundamentals, as we may have seen in the February to March downturn. That's why prices fall more than dividend payments during a bear market. The stock market or even higher dividend paying stocks are no substitute for fixed income or bonds from a planning perspective. However, the volatility and loss profiles for stocks and bonds are much different, even with bond yields so low. But investors may underestimate how helpful the income portion of stocks can be over the long haul. Stocks may be one of the best sources of income for any asset class, and that income may be more important than ever with bond yields so low. So Joe's going to talk a little bit more about historical volatility in the market and put things into perspective based on what we've been experiencing over the past couple months.
Thanks, Dan. Good evening, everyone. As many of you already know, there have been 2 significant moves in the stock market this year. The coronavirus pandemic and ensuing nationwide economic shutdowns have caused high unemployment, government stimulus at record levels, and an unprecedented drawdown of the stock markets. After a positive start to the year, it took only 23 trading days for the S&P 500 to drop 34%. The S&P 500 has since gained back most of this lost ground since it's reached its low point on March 23, 2020. Needless to say, this is quite a bit of volatility in a relatively short period of time, and the year is only halfway over. However, if you look back through history, you can get a feel that huge up and down moves in the stock market that occur in the same year aren't all that abnormal. So this chart shows the calendar year returns of the S&P 500 over the last 40 years, labeled in blue. The chart does a good job of comparing these actual returns to the intra-year declines, or how far the market dropped at some point during that same year. In 1980, for example, stocks began the year by falling 17%, only to experience a significant increase thereafter. Stocks ended up with a positive year of 26%. 1982 saw a similar 17% drawdown, coupled with a major jump at the year end, and returns were up 15% that year. Before the Black Monday crash in 1987 saw stocks get crushed almost 34% in 1 week, the market had a relentless rise to the end of that summer, and surprisingly, stocks finished that year up 2%, even after the worst one-day crash in history. The late 1990s dot-com bubble was an interesting time as the S&P 500 rose by 20% or more for 5 straight years from 1995 to 1999. But even in 1998, the market also experienced a 19% decline before bouncing back and finishing out the year up 27%. The remnants of the dot-com bubble bursting along with 9/11 created a few wild price swings in the market in 2001. Following a positive month in January, the market experienced major volatility with a 30% drawdown during the year. The S&P then regained some of that ground and ended the year down approximately 13%. The great financial crisis bottomed in the early March of 2009, but not before seeing a decline of 28% during the year. The S&P would then turn around and finish the year with a positive return of 23%. So the stock market can move very fast in either direction, seemingly without warning. You can get cycles during a 12-month period that feel like they should be playing out during a 12-year period. Things to remember when thinking about big moves like this is the direction of the stock market cannot be predicted. The magnitude of which the market is going to move can't be predicted. You can't predict when the moves are going to start or stop. And the stock market doesn't always make sense, nor does it have to. So things look pretty bleak in March, and now they don't look as bad considering the S&P 500 is down about 5.5% since the year started. What happens next is anyone else's guess, but down markets provide an excellent opportunity for you to do some minor rebalancing within your portfolio and take advantage of some quality investments at distressed prices. That's why it's so important to stay the course and focus on your long-term goals rather than the short-term market volatility. So speaking of some of the rebalancing and things that you can do within your portfolio, Raymond James is coming out with some new technology that can help us manage portfolios more efficiently, which is what Raj is going to touch on next.
Thanks, Joe. I appreciate the opportunity to share with you guys a little bit about what we've been working on here behind the scenes. I think all of you know a cornerstone of Carver Financial has been continuous improvement. It's one of the things we've been evaluating as a firm are different pieces of technology that may allow us to manage the client portfolios more effectively. So in any industry, technology evolves and it's going to enable businesses to add greater value to their clients. We've been working directly with Raymond James to create a new money management software program that can be utilized not only for our office, but for all Raymond James offices nationwide. So this development process has encompassed us looking at multiple vendors that provide trading, portfolio management, and monitoring technology. So we've taken that research, our conversations with the development team, and we've highlighted what we feel is most important for our clients. We're now piloting this Raymond James discretionary trading platform. So one thing to highlight, the philosophy, the process, and the experience that you have all experienced over time, that will not change. We continue to believe in the value of diversification, asset allocation, and rebalancing. Those are still the cornerstone tenets to our philosophy, and portfolios will continue to be customized to each client's individual goals, objectives, and needs. This new technology just gives us the ability to add some features to this process to maintain and more effectively manage this philosophy. So the specific term of this enhancement is called discretion. Most of you know we will meet with you on at least a semi-annual basis. At that time, we discuss what's happening in your life, the markets, and we make adjustments to the portfolio for rebalancing, tax considerations, or your cash needs. There are periods of time where changes may be needed to be addressed that's going to fall between those meetings. March was a prime example of that. So in those periods of time where the markets are volatile, we can take advantage of discretion and complete things like tax swaps, meaning we're going to sell an investment to capture the tax loss, simultaneously purchase a like-kind investment. This maintains the exact asset allocation, but it gives you the benefit of that tax loss to either be used to offset future gains or potentially deduct from income taxes. What discretion allows your advisor to do is screen the accounts and identify these opportunities and make the adjustment with one click of a button rather than waiting for your planning meeting, waiting to reach out to you on a phone call, or waiting for you to call back. Another example may be a money manager from one of the investments leaves their firm. We may love their strategy, the philosophy of how they pick investments, but when they leave one investment firm, we may need to evaluate other options. So our investment committee may decide to move from investment A to investment B. And because of that manager change, this technology is going to allow us to complete our due diligence and move all clients that own that investment A to investment B with the click of a button. Over the next few months, each of your advisors are going to be speaking with you about your specific situations, the features of this update, and explain, the benefits of how it works. As we move forward, Nik's going to be speaking with you to give you a little bit more insight on our expectations and things to consider.
Thanks, Raj, and good evening, everybody. When we were putting this presentation together, I was just reflecting on conversations we've been having with clients over the last few months. And, one of the questions we get is, what does a recovery look like? And the point I make is there's no all clear signal. There's nobody out there shining a light in the sky or a flag saying this is the way during times of turmoil like we've been experiencing. And this is evidenced in the last couple months. What I'd ask is people look back at other periods of time that were highly emotional. Take, for example, in 1941, the bombing of Pearl Harbor. If you looked at the market represented by the S&P 500, which is a combination of about 505 stocks of publicly traded companies, the market was down about 9.09% that year, including the dividend payouts. But if you didn't look into the future, the next 4 years, you saw very positive returns. In 1942, the market was up almost 22%. In 1943, it was up 23%, 44, almost 20%, and then in 45, almost 40%. And then everybody knows the Cold War came. If you flash forward a couple more decades, people might remember 1979 when oil prices skyrocketed due to the Iran hostage crisis, which put a lot of pressure on the economy because we were so dependent on foreign oil at that time. That's not the case today. But imagine the headlines if oil went from $40 a barrel today, which is what it's trading at, to $80 a barrel in a short period of time, doubling. They may say something like, high oil prices will doom the economy, or pick your negative verbiage. Well, the market was up almost 19% in 1979 and almost 32% in 1980, again, including dividends. But one might say this defied logic. The next slide I have is a chart for a more recent period of time. And it's the time period between 2009 and 2011. This was a very tumultuous time with lots of negative media headlines. But as you can see here, if you take a second, we saw an almost 111% increase in the market over this time period. But if you think back to that time, I'd argue you probably didn't feel very good along the way. So you flash forward to today, and unfortunately, there's so many sources of information that distract us. So the real question I'd ask you, and we do ask clients when we come in for your planning meetings, is what are you investing for? If you're able to focus on this, when the information is trying to distract you, then you're going to participate in the recovery because you're investing towards your goals. But what I could say, it doesn't always feel good along the way. So the next question would be, what should clients be focused on going forward? So a couple things kind of come to mind with this question. So again, to reiterate, first, how you think about investing should be determined on what you're trying to accomplish, which means don't look in the rearview mirror. Why would you look into the past to plan for what you're trying to do in the future? So if you have expenses coming up in the next couple of years, we would want you to set that money aside in either short-term, higher quality fixed income investments like bonds or cash. Or if you're withdrawing from your portfolio to supplement your lifestyle expenses, then we need you to take consideration that you're earning very little interest in cash and bonds today. So you need to allocate more into equities for greater return potential. Otherwise, you could deplete your savings more quickly. Secondly, how will my lifestyle expenses change in the future due to inflation? So everybody might have heard Randy say you probably paid more for your last car than the first house you bought in the last 40 years. Well, that's simply inflation. If you look at the actual historical average, it's about 3%. If you look at what interest rates are today, like Dan was saying with the 30-year Treasury bill being at 1.4%, adjusted for inflation, you're actually getting a real negative return on your money. So essentially, your dollars are silently losing value as time goes on, but you might feel better along the way. So our recommendation, obviously, is to keep a balanced portfolio, keep a portion set aside in fixed income, bonds, or cash for those upcoming needs. Certainly make sure you have enough allocated to equities so that you can take advantage of the rising cash flow in the form of those dividend payouts and capital appreciation to help protect your purchasing power over time. So with all that said, Randy, let's take us home.
Thanks, Nick, Raj, Dan, Joe, and thank you for joining us this evening. We understand your family and friends may have some questions and want a second opinion on what they're doing. We're always happy to speak to them without cost or obligation. We will upload a recording of this event in the next few days on our YouTube channel, and we'll send out a link to that. Our office is open. We are closely following all of the guidelines and also recommendations set forth by the CDC and also the state of Ohio to protect you. We're primarily doing virtual meetings. However, if you really must meet with someone, we can certainly arrange that for you. Carver Financial has been in business 30 years, and we've weathered a lot of storms by keeping our focus on the well-being of our clients, our team, and our community. And we are committed to our mission of making lives better. To do this, we do continue to evolve, and we're excited to announce the new technology that Raj spoke about today and a number of other things we're doing in the rest of the year. Our new logo is a visual symbol of our partnership with you and our mission to make people's lives better in everything we do. The 3 lines in the icon represent your vision, our team, and our global resources. And together, they're moving upward in a trajectory towards a bright and positive future. Our entire team wants to thank you, and I want to thank everyone on our team, plus Scott, who's helping produce tonight. There's always uncertainty about the future and concern about the present. And there's always reasons not to invest. And yet the need is greater than ever as people live longer and do more. Regardless of what transpires, we're here for you, and we appreciate the chance to share your journey and that of your family. So thank you for joining us. Please contact us if you have any questions. Thank you for the 2 comments we just got about the logo, and have a great evening.